Chapter 6, Part 3, Revenue Recognition, Discount, Standalone Pricing, and Incentive Payments. Now, assume Mike's studio has a contract, and they are providing a bundle for $700, and it includes a 25% coupon off their yoga classes for 1 year. They've also discounted the membership by $20, and also they normally give a discount of 10% on all yoga classes. So let's take a look at what information we need. We need to know the value of the membership, the percentage for the yoga. We need to know a normal fair market value of the membership, the value of a yoga student, number of possible redemption of vouchers, 40%, and we also know what do they normally give, because we have to discount that 25% by that amount, meaning that it's only 15% instead of 10%. Now we'll apply our 3 rules. The contract is to provide gym services and a discount on a yoga. So we have 2 performance obligations. Our transaction price is $700. We have to allocate it between the gym membership, which we're going to allocate over the time period, and then we're going to have to recognize the yoga membership value at the time it's redeemed. So now let's take a look how we're going to do that. So first we have to use that fair market value. So the yoga is $500 times 15% discount times potential 40% will redeem it. So it has a value, fair market value, of $30. So our total standalone price is $750. Now we're going to have to allocate that $700. So we're going to take our 1-year membership, fair market value of $720, divided by the total. And that's how we allocate. So $6,720 for 10 memberships would go to deferred revenue membership. That's going to be allocated over 12 months. And the deferred revenue yoga coupon will be booked when the coupons are redeemed. Let's take a look at another example, but in this case we're going to use standalone selling price of the fitting using 3 different approaches. So we have the adjusted market assessment. We estimate what it would sell for in the open market based on other companies that provide similar services. The expected cost plus margin estimates the cost and then adds a profit margin, and the residual approach, which means you use what you know. So we'll walk through all 3 of those. Now, if you cannot use any of these, what you have to do is allocate the revenue over the longest period. So, in this example, what is standalone pricing if we use the adjusted market assessment approach? Now, we know that there's full set of golf courses, clubs, 1,500, and similar club fittings are offered by other vendors for $110. Mike generally charges 10% more than other vendors with similar services. Mike sells a set without the fittings for $1,500. It normally costs $60 for the fitting service, and they normally charge 30% over cost. So, how do we do the adjusted market approach? We use the price of the other vendors plus 10% markup because we say we charge 10% more than other vendors. So that means in that case, $121 would be every time they sell a set, $121 would go toward fitting, and $13.79 would be booked at the time of the sale. Now, what if we use the expected cost plus margin approach? So, we know it costs us $60. We like to mark it up 30%, So that means standalone pricing for the fitting is 78, and we book revenue of 1422 at the time of the sale of the golf clubs. Now the residual approach. We know we're selling at 15, standalone price is 14, which means $100 goes to the fittings. So in that case, whenever we sell a set, $1,400 will go to the golf clubs, and at the time of the fittings, $100 will go there. Now let's look at variable consideration. Now in this example, we have somebody, they're going to receive $20,000 at the end of each month for a total of $120,000, but if they reach specified targets, they'll get an extra $10,000 bonus. If the total savings they're supposed to be providing falls short, they have to pay back $10,000. Now, Mike estimates that there's an 80% chance of getting the bonus. So what's the contract? It's for 6 months of services. We only have one performance obligation, but we also have variable consideration. We have an incentive penalty payment. The transaction price for total service is $120,000 plus or minus 10. Now we have to allocate the performance obligation over 6 months. The company will recognize revenue over 6 months, but we have to adjust for the effect on the bonus. So how do we do this? Well, first we say getting the bonus. We take the $120,000 plus the $10,000 bonus. There's only an 80% chance we'll get it, so that's worth $140,000. Not getting the bonus. That's going to be $120,000 minus 10 times 20%. So we get an expected value for this contract of $126,000. So service revenue is going to be $21,000. $1,000 will go to bonus receivable, and cash will be $20,000. Now, at the end of 6 months, we're going to look at what happens with that $10,000 bonus. Well, we'll get cash of $10,000. $6,000 will remove our bonus receivable we've been booking every month, and service revenue will be $4,000. Now, if they do not receive the savings, service revenue is going to be reduced by $10,000 plus the amount accrued, and bonus receivable will be removed, and we'll book the cash that we have to pay them back of $10,000. That concludes part 3.